Hey everyone, welcome back. It's Rob with Perfect Spiral Capital. Today we're going to start the first of a three-part series in which we are going to look into some terms that are often maybe misunderstood in the financial world. As part of our platform, one of the things that we like to do is enhance and help education for our clients. So today we're going to dig into one of these topics, and that's inflation. Now, most people have an idea of what inflation is, or they've heard some different thoughts. Today, we're going to look at both dictionary definition as well as what inflation actually is and what some of those components of it are. So, to get started, let's take a look at the dictionary definition. And I actually applaud the Oxford Dictionary for giving a pretty accurate explanation of what this is. The Oxford Dictionary describes inflation as a general increase in prices and a fall in the purchasing value of money. Overall, that's a pretty good definition of inflation for the most part. However, it doesn't quite go into maybe the real reasons why there's increase in the pricing. So I've created my own definition, and you can comment if you'd like. If you don't agree with it, I'd like to hear from you on that. My definition tends to be more along the lines of that of Austrian economists, in that the definition of inflation is an increase in the money supply and it's reducing the purchasing power of the currency. So I have a couple of things that I've pulled together that I think will help explain that definition a little bit further, that hopefully will help you understand what's actually happening with inflation. So let's keep it super simple. What is inflation? As we just talked about, it's an increase in the money supply, which then causes an increase in pricing. Let's just imagine that we have one money supply. Let's just say that this $100,000 is the total money supply. That $100,000 is equal to 1,000 ounces of gold. So we have 1,000 ounces of gold that backs this $100,000 in the money supply. Now, we know that each one of those dollars is then tied to gold in some way, shape, or form. And in this case, we'll get into the fact that our dollar isn't tied to gold anymore, but I don't want to jump too far ahead. So $1 might today, we're just going to use this as an example. It doesn't mean that it's true, but $1, let's just say for the sake of example, is equal to 1 can of soda. So what happens in the case of inflation is the money supply gets increased. So in this case, let's say an additional $100,000 is contributed to the money supply. Well, what's happening there is now we have $200,000, quote unquote, still equal to that 1,000 ounces of gold. The value of the money has not increased. And in fact, the value of the money has decreased because we've not increased what the money itself has been based upon. And this is where we look at now, if you were to fast forward, it now costs $2 for 1 can of soda. Now, that doesn't always happen overnight, of course, but that's the type of situation that we're actually facing. And I think some of you, especially those viewers who are maybe a little older, you've certainly seen inflation take place over your lifetime, where something that used to cost a small amount of money has now skyrocketed and is maybe costing a significant amount more. Well, why does this happen? Well, over time, our money supply has been increased and increased and increased. And the things that back that money really have not grown in fundamental value. And in the past, we used to have our money backed by gold, as I used in the example here. However, that's not been the case since at least 1971. And over time, the money supply has been increased and the value or the number of dollars required to buy an ounce of gold has increased as well, because we have not continued to increase those reserves, and then eventually those reserves were completely removed. Well, the method behind it that a lot of these Keynesian type economists like to think about is that the economy will grow and it will accommodate that growth. Well, we can clearly see, and I think most of us have felt, that method truly doesn't work in the real world. In fact, our money just continues to lose value. So let's think about, though, why the money supply increases. Who's increasing the money supply? First of all, being that we're on the fractional reserve system, it's going to happen in these three distinct ways. So, number one, the Fed has the control to add liquidity, or liquidity meaning dollars, to the system. It increases the money supply. So, that's a direct situation where the Federal Reserve is going to print more dollars. Now, they don't do that all the time. Sometimes they actually cut back on adding to the supply, or they even might buy back and decrease the amount of supply, which does and has happened on occasion. However, that isn't a policy they like to do very often, as we'll see in a graph illustrating how inflation has grown in the future. That being said, there's another way in which inflation takes place. Not necessarily as well known, but is still very, very real, and something that's been in the news a lot lately. And that's federal policy, or federal monetary policy, as it pertains to the budget. When there's a budget deficit, where does the United States get that money from? They go to the Fed. Well, where did the Fed get the money from? It generally didn't exist. So they're increasing the money supply. Every time that there's a budget deficit, that's an increase to the money supply because there are no reserves to back that money. In this case, if we think about our annual budget deficits, last year alone, for the fiscal year, there was $1.8 trillion added to the national deficit. That is a huge amount. And when we think about that, that's like taking $1.8 trillion and printing it and putting it into the money supply. Well, what's going to happen, right? We just saw that can of soda that cost $1, instead of it costing $1, it's $2. And before you know it, that can of soda is $3. And that cycle and that process keeps happening. Politics and budget aside, let's talk about one other way that most people are completely unaware of that increases the money supply. And this one might be very surprising to a lot of people. But anytime a bank is lending money in our current economy, current state, in almost all cases, it's actually increasing the money supply. So every loan a bank makes is generally increasing the money supply in some way, shape, or form. Now, you might say, well, how is that even possible? Well, let's talk about it. Let me show you. So any bank that is borrowing money above the reserve capacity of the bank is going to increase the money supply because that money did not exist before. So imagine you have a bank that has $100,000 in deposits. Well, they're probably going to go and try to leverage that money at 10 to 1, meaning that for every $1 they have, they're going to lend $10 out. So that $100,000 becomes $1 million in loans because the way that banks make money is through some of the loans. We talked about that before in one of my other videos on how banks actually function and make money. So what most people don't know is that many banks nowadays do not even lend out at 10 to 1. There's many banks that are actually leveraged at over 100 to 1, meaning that they're lending out $100 for every $1 they get in deposits. If you think about that, that's why we are actually much more prone to bank failures today than what we ever had before. The Federal Reserve themselves has set the reserve requirement for banks at 0. There is, since 2020, there has not been a reserve requirement for banks. So they've kind of run wild that way. Now, not all of them are going to do that. A lot of them are still physically smart, and they're going to try to protect themselves and their customers and their income source. So they may not typically go quite that far, but it's still a situation in which every loan they make is contributing to the money supply. It's contributing to the costs going up for you and me and everyone else in our country that's using our dollars. When we think about the fractional reserve system as a whole, knowing that there's three primary ways in which inflation is taking place, in all honesty, it feels pretty evil. And I know that might be a strong word, but I'm just going to be flat out about it. It frankly is evil to me when someone's printing money or creating money out of nothing on the backs of requiring everyone else to soak up those funds over time. Now, why do I say that? Well, the people who get to use new money first are the ones who get to benefit from it, and then everyone after that every time that money changes hands after that, those are the people who feel it. So the people who get to use it the first, second, or third time, not a big deal for them because they had free money that essentially came from nowhere that they were able to generate. And who are the people who are doing that? Well, it's our federal government. It's the banking system. All of these two primary groups are using those funds first, and then it trickles downward, and ultimately the people who have to pick that up are at the you and me level. We're having to foot that bill through higher costs, through devalued currency, etc. What I'd like to do next is show you a graph I was talking about earlier that shows the cumulative level of inflation that's taken place since 1912, more or less since the implementation of the Federal Reserve. And we can see that from this period of 1912 to all the way out even to 1971, inflation was
Mhm.
growing. It was still happening. We had it at play. We do see in the 1930s that there was a decline or a contraction, meaning an improvement in the value of the money. Although that's a separate topic in and of itself if you really understand the facts. And there was a significant amount of money removed from the economy, which is why we saw this decline. But again, separate topic for a different day. Since the removal of the gold standard in 1971, though, we've seen inflation just continue to go up at an enormous rate, and it almost never comes back. No one is doing anything, whether that's the Federal Reserve policy nor the federal government, to rein in inflation. They've just accepted it for what it is. Well, why is that a good thing? It's really not. It's actually sold to people as though it is a good thing for you. And the reality is it's not good for you. It's not good for any of us. It's not good for our country. Oftentimes today, we hear that inflation is a good thing for the economy in some ways. And quite frankly, that's just a lie. Inflation is not good for any of us. When we see on the previous graph how money has been completely expanded, we feel it through real estate prices, how homes have become unaffordable for a lot of people. It's because of inflation. It's not because the homes gained in value. It's because we've had this significant reduction in the purchasing power of our money, and homes have continued to hold their value. A great example that I like to use often is with gold. In 1912, 110 ounces of gold easily bought a nice 3-bedroom, 2-bath home in a very nice neighborhood. And if you fast forward to today, you can still purchase a pretty nice 3-bedroom, 2-bath home for 110 ounces of gold in most markets. Now, there's some minor fluctuations to that, but generally speaking, it holds true. So what's actually changed? Nothing, at least in terms of gold and the value of the home. Those things have held still. It's that our money purchases that much less. And that's really what I'm talking about with inflation. The supply of money has increased, therefore, the value has decreased in terms of what it's capable of purchasing. Here's another quick graph that just helps to illustrate what I'm talking about when we're talking about gold being able to purchase a home. We can see here that in 1912, gold was roughly around $20 an ounce, give or take. And, over time, we've seen that the price of gold has significantly increased. And then in 1971, as I was just talking about, the gold standard was removed, and we've seen the money continue to inflate. And we've seen the price of gold go up considerably, well over $3,000 of an ounce as of more recent. Now, again, this isn't to say that gold is worth more. Gold, like we just talked about, is still worth about the same amount. It's just that the value of that currency has declined. Before I get into some ways to help protect against inflation, I think it's important to call out that there are other types of inflation. And it's not simply that and these are more price inflation items. These are not situations where the money is actually worth less. This is more of what most people tend to think inflation is. So there's certainly some different aspects to it. And let's start with a couple of those. So one is tax driven increases in prices, meaning let's say your state government or your federal government adds a new tax on a particular area of the economy. Those prices are on those areas or from the companies that have to manufacture those products that have to pay those taxes. It's directly going to drive up the price of that item because most all companies want to be profitable, and if their bottom line price increases, they're going to pass that on to their consumer. Now, some people might say that that's a bad thing. Well, I don't think you go to work at your job for free, and I don't think anybody else does either. And you would want to be compensated for that if your costs at home increased. And again, might get into separate topics on that, but I simply just want you to think about it a little differently that way. Secondly, shortages. So let's say there's a short-term decrease in the supply of a particular item that's needed to make something. So maybe there's a decrease in or a shortage in aluminum, and a company that makes something out of aluminum might have to increase their prices temporarily to help ease back the demand on that item that they're selling until that supply can come back. That's normal supply demand type aspects of economy. Another might be that there's a more permanent impact to supply that would increase the production cost for a sustained period, meaning that there's a long-term shortage on a particular type of item that's made to manufacture something. An example might be, let's say there's a massive shortage that's projected for 10 years on computer chips. Well, what's going to happen to computers? They're going to increase in price. So I think those are pretty basic ways that most people have understood those things. Now, another area that can actually impact the supply is, again, with regulations and taxes. The EPA says you can't build or do certain things in certain areas, and that might decrease the supply of a given item needed to manufacture something. So just some examples of how you can have actual price inflation over and above the actual inflation of the money supply. So all these things kind of work together and help us understand what inflation is. As we look to try to wrap up this topic of inflation, what can we do about it? It makes us feel kind of helpless in some ways that we don't necessarily control what the Federal Reserve's doing. We don't necessarily control how banks operate. We don't necessarily control how the federal government is going to structure monetary policy, but we can do something about inflation. And we have to look at how we sort of protect ourselves against inflation. And we can do that in a few different ways. One of the ways that we can help protect ourselves against inflation is to acquire assets that are more of a store of value, or maybe even have a guaranteed type of component of growth to them that will rise with inflation or outpace inflation over time. Let's look first at stores of value. Well, there's a couple of different ways we can approach that. One might be with land and property. As we've just talked about, the price of property generally appreciates, although, again, most of the appreciation tends to be the devaluation of the currency, but property does and can appreciate because there's a limited supply of it, and there's less of it available generally each and every year as population expands and so forth, right? So those are ways that land and property can be a good store of value. Separately could be with gold or precious metals. Those are great ways to be able to insulate against inflation as well. But again, remember, it's a store of value. It's not necessarily making you more money. It's just that its value holds the same. Whereas with land or property, that could actually cash flow. You could rent out a piece of property and generate a flow of cash or a flow of income as a result of that. It's a little bit more difficult with stores of value such as gold or precious metals. Another is like fine arts or collectibles. Again, harder to generate cash flow on those, but they are stores of value and do help hedge against inflation. Another is guaranteed growth assets. So these would be assets that are guaranteed by contract to always be growing. They're always going to create more value in and of themselves. So they will generally outpace, providing you with some sort of shield against inflation. These examples might be with annuities, for example. There's guaranteed annuities out there that will run with and exceed inflation. Another would be, and much like what we kind of talk about here at Perfect Spiral Capital, would be dividend paying whole life insurance through a mutual provider. Those types of contracts are guaranteed to always go one way. They only go one way and they go up. And it also provides a different use of those dollars. Now, I'm not providing financial advice in this particular situation. We're simply just talking about ways to help insulate against the silent killer out there to our futures, and that is the inflation aspect. One other way that someone could potentially insulate themselves against inflation would be with investments. Now, I think it's really important to call out, and we'll get into this in one of my next videos about investments, but investments can be good options, but they also do carry risks. And what risks do you control in the investment? I think that's a really big one that people need to think about. True solid investments are one in which we really know about the risks involved and we can mitigate those risks. And how well are those risks mitigated and prevented from impacting the growth of that particular investment we've made? Separately, most good investments, or any good investment, should have a really thorough plan of attack as it pertains to preservation of principal or preservation of the capital that we've input into the investment. And that's an absolute must in any sort of investment, that we have some sort of risk mitigation strategy. That's a critical component in being able to help fight this inflationary problem that we face. Lastly, can we operate outside of this fractional reserve system? Well, the dollars that we're denominated in make that kind of difficult to do so. And despite all the flaws that we face with the dollar, it's still the best one out there in comparison to every other type of currency in the world. So it is a decent option, but at the same time, we still want to say, can we at least maybe not contribute to the problem? How could we avoid contributing to the problem? And that's one of the things that we help educate our clients, that I help educate my clients to do, is look at ways to structure your own bank. Look at ways to structure and create a banking system for yourself that allow you to avoid contributing to the system as a whole. And that's one of the biggest things that the Nelson Nash Institute and the infinite banking concept are really derived around. And that's controlling the banking function in our lives so that we don't contribute to this system and make it continue to get worse. If we can grow and create a larger scale to the infinite banking concept, we can actually begin to turn the tide with inflation. And that's a whole different conversation to get into, but I just want to highlight, it's one of the things that we try to educate our clients to do here, is create that system, control the banking function in your life, so that not only are you going to outpace inflation, but it's going to give you the capital that you need to be able to deploy it in the ways that you see fit to help your system and situation grow beyond what you ever thought may be possible. I hope today's video was informative for you and that you learned something different about inflation, or maybe see inflation from a different angle. And separately, I hope that it's maybe challenged you to do something about it for your personal situation. If you found this video valuable, feel free to like and subscribe. Take a look at some of the other videos in this series to try and understand and enhance your level of understanding as it pertains to your financial education. Thanks for your time and have a great day.